China has been printing money at a rapid clip, just like other central banks. They have been supporting the stock market by buying everything that they can. Sound familiar? Well, of course, this is a global plan to inflate equities. Despite all of this intervention, it seems as though the market has slid close to a critical point. You came here for the truth, so let me unveil that for you. Today we're going to look at the situation in China. I want to talk about the United States, Canada, and the globe. Let's begin. Look at the Chinese stock market. You will see something very important. China's stocks near a key level after sell-off. 3,000 is that critical level. This was nearing that range back in 2017, again 2016, and the potential for here in 2018. I want to show you, however, that as of this recording, the market has climbed a little bit here and has made its way over the 3,100 mark. So let's talk about this when you look at the level of 3,000 and how it is important in terms of technical indicators for the Chinese stock market. The big question for investors is whether China's so-called national team is committed to defend 3,000, which proved to be a key level of support for stocks around this time last year. China's government, which has long history of market intervention, has recently shown signs of prioritizing financial stability as the economy grapples with the escalating trade issues and uninspiring growth figures and tightening liquidity conditions. Now, they're calling this tightening. I would like to have a difference of opinion on that. However, this is what we're talking about. We're looking at the level of 3,000, and remember that while fundamentally that level doesn't necessarily mean anything, to the technicals it is important. Wednesday's rally in large caps is an important signal that the national team may have entered the market. There we go. The national team is likely to defend the Shanghai Composite at 3,000 and need to hit the brake to prevent the sell-off from accelerating. While we don't have confirmation that's what happened, that's probably what happened. And most investors don't really care. They simply want to see their stocks continue to rise, and they don't want turmoil. So maybe they don't even invest in that market. They just don't want it to go down because they're worried about contagion. They're worried about the dominoes falling. And of course, they should be. So this right here is something that I think is critical to understand, that when there is fragility and risk in a market, you will often find the plunge protection team, the different central banks around the world, they basically go in and they make sure that there is a crutch, a support to this system. Okay? Look at this. We're looking at the China CSI 300, okay, top 300 stocks here, and you will see what has happened over the course of, peaking out in January, right at about the same time the US stocks have, and declining ever since. They're also showing a correlation between the US and the America index here at 84%. So that's something to note, that they are quite correlated, and I believe that all stock markets for the most part are correlated at a high degree. Global debt, I've covered this many times. I just wanted to touch on the fact that it has increased so dramatically, and the only solution that any government has is to encounter more debt. I mean, how ridiculous is that? The suggestion of reducing debt and deficits is laughable. United States stands out. Amongst advanced economies, only the United States expects an increase in the debt to GDP ratio over the next 5 years. I don't know how they're not all just terribly, but here is the United States sticking out like a sore thumb. You can see everything else, whether it's Cyprus, Greece, Germany, Portugal, Iceland, and so on. Apparently, the US stands out in this regard. Not really sure, but we'll have to see. This is Canada. Canada has decided to keep their interest rates essentially the equivalent of the Fed funds rate from the US, at 1.25. So this level here is specifically to maintain the real estate market. If you don't maintain that market, you're going to have a complete recession in Canada. There's no doubt about that, because the entire market is really relying on it. Canada's share of US non-energy goods imports has been declining steadily. Look at where it was in the year 2002 and look at where it is going up to, I guess, last observation was 2017, but essentially we see the trend, and that is declining. And that's not good for Canada's economy, because you can't just have one thing that you do. You need to have various, things that you can export. You need to have services within your country. You need to have investment coming in. There needs to be commodities. There needs to be resources. Everything. You want all of that, because if one is doing bad now, at least you have the other things. That's why you want multiple streams of income, for example, because if one isn't doing so hot, you have the others there to back you up. That's not what Canada is about, unfortunately. This here is interesting because we're comparing two of the biggest stocks in the world. That is Amazon and Apple. The question many people are asking is, who will be the first $1 trillion company? If you said maybe 2 years ago that Amazon would be in that position, that was considered to be, unrealistic. But look at the growth rate of Amazon. It is insane, truly insane. That connects in, of course, loosely, I would like to mention loosely, with the retail sluggishness, and that's me being polite, that is experienced right now. I mean, it's crazy to see how many stores are closing. In the next video, I'm going to cover actually a lot of those retail closings that are being experienced here. So just to show you these two stocks, I thought it was an interesting chart. And then we have US banks posting the highest earnings per share since the financial crisis. So here we are right now looking at the US banks, which in this case here, JP, Citigroup, Wells Fargo, Bank of America. Okay, I'm not breaking it down specifically, just noting the fact that earnings per share continues to increase. Now, what is the one way that you can create a fake boost to your earnings per share? And that is stock buybacks. Now, I happen to remember doing maybe, just 1 or 2 videos on stock buybacks before. You may have seen them. And note this, that this is the best way to improve your earnings per share. All you have to do is take that big pile of cash that you're sitting on, buy up your shares, send the price rising, send the earnings per share rising. It's going to be an easy win. And that's what's happening right now. You just take a look at these banks buying back their shares. You look at all the stocks buying their shares. There's just so much cash floating around. Not for you and I, but for the big corporations. The biggest US banks made $2.5 billion from the new law that was passed. Pretty interesting here. So they are able to utilize this and benefit greatly from it. Last but not least, I like to give you all of the sources. I like to tell you all of the websites and the different, critical indicators that you need to pay attention to on your own if I'm not covering them here. One of them is the Federal Reserve's Beige Book. I've shown you quotes from it before, but ultimately this is something that you periodically need to keep up on. So this is from April right now, and you can go back and see previous ones if you're interested, but just definitely check up on it. At least try to, keep your ears open and eyes open for anything talking about the Beige Book, because you want to know what the Fed is saying. Now, you want to know that in one way. What they do and how they act is one thing, but what they say sometimes I should say, is very important. So take a look at the Beige Book here. You can go to the federalreserve.gov website, look for the Beige Book, or just type in Beige Book Fed April 2018. You'll get that. That's how I was able to pull this one up here. Continuously check up on it and see what the Fed themselves has to say. So you can see all the different Feds and what their points are. So they may not all agree, remember, because there's the 12 Federal Reserve districts. Go through that. That's all. If you found this video informative, please give me a thumbs up. I need the support more now than ever, so when you give me a thumbs up, when you comment on these videos, you are definitely supporting this channel, and I really do appreciate that. Thank you all. If you found this video informative, I know that you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. The links are in the description below. Just click on that. It'll forward you over there, and you'll be able to actually flip through the pages to see if you like them. Take care.